Welcome to tonight's edition of MAREI Virtual Live. It's part podcast, part webinar, kind of doing a podcast with an audience. So joining us tonight is Alice Lund with the Roller team, and she brought Kevin Roller of the Roller team, and also Beth Langston from Flat Branch Mortgage. So I'm going to go around and let you all introduce yourselves. On my screen, Alice is first. So Alice gets to go first and tell us a little bit about herself, and then Kevin.
I'm Alice Lund. I started in mortgage in 2003. I've spent the last 20 years of my career split between home improvement and construction and the mortgage industry, about half and half. I've been on the Roller team for over 3 years now, and a member of MAREI for over 3 years now too. The first organization I joined, and by far the one that's had the most impact on my business, the people that I've grown to really trust.
All right. Kevin, tell us a little bit about you, how you got into it, and what do you do in real estate besides being a mortgage person?
Yeah, so obviously I'm a lender. I've been in lending for 23 years in May, so quite a long time. Love what I do. I also got into buying rental properties as well. So I think it was my 55th door last week in Mexico. Got a new condo in Playa del Carmen, and it's already rented. So I've got 55 doors here. All of them besides the one in Mexico are in the Kansas City area, predominantly Johnson County. So I'll turn it over to Beth.
Well, I started in 2003. I have been in mortgages since that time. I have been with a couple of companies, but I have found my home with Flat Branch. They kind of allow me to develop products and services the way that I think Kansas City needs them. And so with investment being one of my key focuses, I kind of have a system from whether it's rehab all the way to a lease purchase and everything in between, as well as helping people get commercial loans. I have enjoyed my membership with MAREI, have met just so many cool people.
So my initial thought for this meeting was I have a house personally for sale. My son was the listing agent, and we're talking about seller paid closing costs and rate buy downs, something that I don't think we've really seen very much of in the last 2 years. And while he knew what seller paid closing costs were, this whole concept of a rate buy down, who was buying down a 2% loan? Not many people, but now we're at 6%, that 2%, the rate buy down's coming back. So I thought we ought to get online and explain some of these, not just for investors might be trying to incentivize selling their house so they can offer these as incentives. But we have a lot of investors that are trying to get into their first deal, their first house hack, where they're going to live in one room and rent out the rest of the house, or they might be going to buy a fourplex, live in one unit and rent out the rest. They can use all of these tools as a owner occupant buyer to get in with less money. So I wanted to go through some questions, and as we went through the questions, a few more came up. So we're going to wing it here. Beth, first up, seller paid closing costs. Tell us how that works. Is there a limit to how much the seller can pay, percentage wise, dollar wise? Are there certain loans it doesn't work with? Just a little bit about that.
Regarding seller concessions, they are pretty much all over the place, depending on the loan type that you have. Some are maxed out at 3%, some don't have a max, some are up to 6%. But on investment loans, if it's a straight conventional, if the investor's buying it, we have a 2% cap on that for a seller to be able to sell to an investor and help them pay their closing costs. I think maybe most of people that would listen to this webinar are keenly interested on how the investor would be benefited if they're purchasing. But then again, if they're selling to a first-time home buyer or maybe their tenant, they have to keep in mind some seller concessions that can make it very easy for a tenant to buy if they're qualified. For example, with FHA, with down payment assistance, they can use part of their lease deposit. If you have any extras overpaid in their lease, you can use that as part of down payment, as well as a concession for their closing costs, which can also include a buy down, which a seller can pay. So I've had buyers buy their own house that they live in and lease for very little money, under $1,000. If a seller doesn't want to rehab again and wants the beauty of just, hey, let's go ahead and buy it while the value is high, or sell it while the value is high, we can help them structure the jigsaw puzzle in order to sell the tenant that's already in place.
So I'm going to back up here on one question. You said for an investor loan that sellers can pay up to 2% for an investor loan, but that is a non-owner occupied loan, correct?
That is correct.
If the investor is house hacking and moving into the house, he is an owner occupant, and then the limits are all over the board again because he's an owner occupant buyer, correct?
6% on average, yeah.
And then on the investment side, you can, if you're buying like your first property, right, and you want to buy a multifamily and you're going FHA, that's where it would really come into play too, the 6%. Because you could buy a fourplex for 940,000, let's say, and put 3.5% down and have the seller pay closing costs. You could use all the same credits that Beth spoke about.
You could slip a buy down in there too, which would be nice.
Yep. Yeah.
We're going to hit buy downs here in a minute, so you'll know what those are. So if we are selling to an FHA buyer, is there a set limit on what the seller can pay on seller paid closing costs? Beth?
6% is the standard. If you're going to include a buy down in that, I highly recommend if their buyer is wanting to get a buy down included, which we'll go over that, but it reduces their payment for a 3, 2, or 1 year time period. I highly suggest that they get the cost of that before they ask for their incentives. Most agents that I talk to think, oh, I'll just ask for 3%. Well, you know, on a $500,000 loan, that sounds like $15,000. Well, you may need even more than that to get both the seller paid closing costs as well as the buy down. I know that sounds like a ton of money, but it is something that they can take advantage of, especially with FHA.
Beth, I feel like the conversations we've been having with the sellers are like, advertise your property this way, and yeah, you're paying some, but what would you maybe be reducing your listing for?
Right.
It's smaller than what a normal, typical like maybe price reduction would be. And it's a hook to get people into the property and really a value to them. So.
I agree. And especially when you're seeing properties in an area where comps have been really good, maybe you have a seller with multiple properties to be their own comp. It's better to give the incentives at the higher price than to lower the price and not give any incentives because you're keeping the comps high. It may be slightly artificial, but especially like for new construction, that I do a lot of that where we're giving the incentives off the higher price. That way, all the buyers that bought before are not unhappy there because their house is still the same value.
Really big in the new construction.
Mm-hmm.
So,
And for our listeners, I'm going to say that both companies offer very similar loans. They might have a few that are a little bit different, but very similar loans.
Yeah.
So what is a rate buy down?
I'm going to share my screen with an example. Tell me if you see this.
Yes.
Okay. This is a very generic example of we have buyers all the time that are really surprised about the rates. If they've doubled in a year, they're like, wait a minute, the house payment has gone up several $100s. I used to be able to afford that. What's the problem here? So we can go through to get them. I have a 2-year example here, but there are 3-year and 1-year as well if you don't have room to ask for this full incentive for your buyer on your concessions, because sometimes they need closing costs more than they need a buy down. But for example, this property value is $200. The loan amount is $160. So they're putting the 20% down, 30-year fixed rate, 4.875 the first year. We're assuming that we're locking them at 6.875, which is the 30-year rate. But on the first year, they get a buy down of 2 points to 4.875. Second year, their payment is based on 5.875. And third year, 2 years later, we're hoping that we get in a refinance market, right, guys? And so we don't even need this third year, but with the Fed, who knows right now. People have often asked me, well, if I give up that much money to a buyer and you go ahead and refinance them 6 months later, how is that a benefit? Like, where does all that money go? Well, the money goes into a separate escrow account, and the lenders, as they take their payments, take the portion of that interest that they have saved every payment. They're going to take a little bit out every year. So if they have not used the full benefit in that 2-year time period on this example, then it will either be forwarded to their refi if they're with the same servicer, or it will be put down on their principal and lower their payoff. So right now we have buy downs both for conventional FHA, USDA, and VA on purchase transactions, and we do allow investors to use these as well for their own purchases. So since 2% max would be Their maximum, we'll have to price that out depending on the price of the loan. I also have 3-year examples and 1-year examples, but this is really the most popular is the 2-1 buy down so far.
We were trying to give them a broad overview. If they have specific scenarios, definitely get with you guys. But we have the seller paid closing costs, and then we have the rate buy downs with Beth has shared. But I asked Alice if there's some programs coming from different states that could help pay with those as well. And I know that they don't work for an investor non-owner occupied loan necessarily, but they would work for an investor if they were going to live in the unit or an owner occupied loan. So Alice, take it away.
Kim, are we going to come back to buy downs? One thing, you could explain it, Beth, but just maybe for people that don't quite understand the difference between like a discount point and like the buy down.
Yeah, discount points are permanent. So you can pay thousands and thousands of dollars and have your rate go down 1/8, 1/4, a half on your long-term basis. But in this market, I personally don't advise that just because we're hopefully going to see some kind of relief here in the next year. Maybe we'll be lucky to get to under 6, 5.5, that'd be great. So there's no reason to pay for a 30-year benefit with that much money if we're going to just turn around and get rid of that and refinance. The temporary buy down is a very good benefit for a short-term help to help people grow into their house payments and be at a rate that they already were pre-approved for at the 30-year rate.
Yeah.
So what do we have in government programs?
The down payment assistance program that we use probably 95% of the time is MHDC. It's for Missouri. The presentation that I have here, it's specific to targeted areas. We could cover the difference between MHDC that covers all of Missouri and doesn't have a specific area requirement, and then the targeted areas. Because I'm sure you've seen it advertised, there are some community redevelopment programs that banks offer. Sometimes the government comes in and says, hey, you weren't lending as much to this area as you should have, or you made too much money, or whatever the case. And they say you have to allocate a certain number of millions of dollars to this redevelopment act. And those are the programs that they have a certain amount of funding. They really have great programs. They rival the bond programs like MHDC, but then they run out of money. Kansas also has a down payment assistance program. It's called KHAP, and it's wonderful. It just doesn't have the funds. It was great during the pandemic, but we haven't been able to use it for a while because it doesn't have the money to cover the down payment. There's another program you might have heard of. It's called Chenoa, and that is a national program that's available in all 50 states. I don't want to bash on any program specifically or anything, but it's really expensive. There are substantial fees associated with Chenoa. And so unless they're offering their max offering, which is 5% down payment assistance, which can cover a 3 or a 3.5% down payment, and then also leave money to cover their fees, it just doesn't end up being a benefit to clients. And so we really haven't used that. HDC is a great program. We use it a lot, and provides a great opportunity to get affordable interest rates on properties with no money down. MHDC stands for Missouri Housing Development Commission. And so the way the down payment assistance works, it's a forgivable note. It works with either conventional or FHA loans. First-time buyers can do a reduced down payment on conventional financing, which goes from 5%, which anyone can get on a conventional note, to 3%. And then with FHA, the minimum down is 3.5%. HGC is a 4% down payment assistance, so it covers the down payment for either one of those loan options and has a little bit of scratch left over to cover some of the closing costs as well. Everybody gets the 4%. MHDC sets the rates. Beth and I are going to have the same interest rate for that client because MHDC sets the rate. We still underwrite the file. It has to be approvable based on MHDC's guidelines. So there's a little bit of a check by them at the end that we've done everything correctly, but we're still underwriting that file in-house. It's available. There's options for first-time home buyers and repeat buyers. And currently there's interest rates on a 30-year fixed as low as 3.375%, which that's pretty cool. That it's up from, it was 2.875 for a long time. Where that comes into play is you don't just have to use the bond program or down payment assistance program if you don't have a down payment. So you get the best interest rate if you have your down payment, but you want to use this program, and then if you're in one of those targeted areas, and we'll go through a few slides that'll show you how those areas are determined, and those are areas that they're wanting redevelopment to occur, and they're based off of the census, and the census is only done once every 10 years, and it was done in 2012. And so we're kind of excited because once the census comes back out, there's going to be new census tracts, which are hopefully going to give us some different areas that are going to qualify for the targeted area interest rates. So extended income limits. A lot of times with those bank programs, the income limits are super low. And so it really restricts families from being able to qualify, because even if just the wife is on the loan, it's household income and things like that. And it's just really easy to get over the limit, but still be in a position where, you know, first time buyers and or single people that they really could use those extra funds. So, and a big thing, and the reason we love this program so much is because it eliminates that cost of waiting. You think about, you know, people that want to buy a house, have good jobs, they're ready to go, they're sick of renting, but they have not saved that down payment and their closing costs yet. And being able to buy a house now rather than spend another 2 years putting money into a savings account and building up that down payment, this program allows you to be able to buy a home and not have to wait until they've appreciated even more. I won't go through just the whole targeted area part of this presentation, but I'll just show you a little bit. These are some of the counties that the targeted areas are within. This is one of the areas that qualifies. This is down by Garozzo's, Caddyshack, Vietnam Cafe. It's by the River Market and the P&L. So there's some cool parts of Kansas City that qualify. This is just north of Belton, southeast corner of 71 and 150. This is by Winterstone Golf Course, 291 and 24 Highway. South of downtown, kind of by Oakwood Country Club, kind of South Kansas City, Missouri, by Blue Hills. And then south of Blue Valley Park, right by Arrowhead and Kaufman. Our favorite things to do with the MHDC program, first of all, we love to give it to the buyers, but we also love to work up a flyer for our sellers that have listings in that area and can say, this house qualifies for special incentive financing, 3.375. You know, it's a way to market your listings. Beth, you were talking about how you can use some of the rent deposits to, what was that you were saying?
Well, if you're selling to a tenant, there are opportunities to bring in as much proof of cash or prepayment of down payment into that transaction as possible. It has to be very documented. You know, it's not a document you make up after the fact, but some people are on lease purchases still that have an overage, you know, that's carried over. If their security deposit was trackable, you can put that as a credit towards their down payment. I have one that I'm closing later this month. They're literally bringing $400 to closing. That's it.
And that's cool. That's the value of working with someone like Beth or a team like us, because these loans probably happen all the time, all over Kansas City with clients that are buying their rental property, and no one even thinks of that. And so it's nice to work with subject matter experts that understand the little things that can help you benefit. This last one, it's just a snippet from the MHDC website, and it's outdated actually here. This is where that 2.875, it's 3.375 now, but this is the first place program where it talks about the targeted versus non-targeted areas. So if you can buy a house in a targeted area with no money down and your interest rate on the 30-year fixed is 3.875. And then in a non-targeted area, it's going to be in the mid fives. And you also still can qualify for, because if you're a first-time home buyer and you're qualifying for that program, you can get reduced MI and things like that as well as a first-time buyer.
Back in the day, we haven't sold a lot of houses this way in a long time because everybody's been paying cash or conventional. But between 2009 to probably 2018, whenever we sold to an owner-occupant buyer in Missouri, 9 times out of 10, they were getting an FHA loan, FHA guideline loans. They're going through MHDC. We were paying their closing costs and MHDC was doing their down payment, and they were getting in for nothing. I mean, they had a few closing costs, maybe a couple $100, and I sold house after house after house
Yeah, and MHGC can kind of get a bad rap. Like I was talking to somebody who said, I don't like it. They've got that, it's a second lien on the property. And I said, well, it's 100% financing. So when you buy the house, it's 0% interest on that second lien, and there's never any payments. And so, what else is a 100% financing loan? A USDA loan, a VA loan. The only thing that you benefit from on a MHGC loan is over the course of time, your loan, it just goes away. So the way
And how long is that for? Is that 10 years?
Total, is it after 5 years, it starts to tick down, right?
Starts in year 5 at 20% per year. So year 5, 20% is forgiven. Year 6, 40. There was one question asked about it, Alice. Is this for first-time home buyers? They are for first-time home buyers that have never owned a home, but if you haven't owned a home in 3 years, you're reconsidered or considered a first-time home buyer. So you can go back again.
And you can still do the non-targeted areas as a first-time home buyer, just not with the lowest of the low rates, right? Yeah.
But you don't, two things. The one thing I want to go back to is that it's now available for conventional loans. It's not just FHA. You can combine it with like Fannie Mae, Home Ready, or Home Possible Freddie Mac. And then second thing, it depends on the program as far as the forgivable aspects. And when you take out the loan, they're continually changing it. And you don't have to be a first-time home buyer anymore. You can currently be a homeowner and use this program. That's the first.
On their other program, there are next steps.
Yeah, next steps.
So then the question is there a similar program for Kansas? And that was your KHAP that you were talking about, but it's out of funds.
There's multiple programs in Kansas. So really HUD distributes money to the states to use. And the state then can use that money for a program. If you, in the state of Kansas, if your MSA is large enough, your metropolitan service area is large enough, then they give the money to that MSA to use as they see fit. So Johnson County has its own MSA. Wyandotte County has its own MSA. Shawnee County, or the Topeka area, has its own MSA. And then Sedgwick County, which is predominantly Wichita, has its own MSA. The rest of the state falls underneath the home program. The home program is an amazing program, and it is just the best program I've ever seen. You can't use it if you live in Johnson County or Wyandotte. Johnson County really, they use their money more for rental assistance. They use a small portion of it for first-time home buyers, and it's usually gone the same day they put it out. Wyandotte County has a program called CHIPS. I used to be on the board for CHIPS. Great program. They usually have enough funding for about 10 homes. Sometimes they can fund a little bit more depending on if they've bought and sold and how they're distributing the funds. And then there's Chenoa and KHAP. So Chenoa works in the state of Kansas, KHAP works in the state of Kansas. And then it's going to depend on the person's income, credit score, debt to income ratio. The best program, like I said, the home program, which is not eligible in Johnson County, not eligible in Wyandotte County. But if you're purchasing just outside like in Leavenworth or something, that program can give you up to 20% for the down payment, but you just have to be in a lower income bracket. Jesse, can you speak to Chenoa just briefly?
So there's two options for Chenoa. There's a 3.5% option that they'll give you, or a 5%. The problem with Chenoa right now is that the cost for those rates, make it pretty much obsolete to even use that program. Because your closing costs for the discount points that they're charging to get those rates pretty much wipe out what they're giving you for the down payment assistance. So most of the time it makes more sense to go with just a straight FHA loan anyway, but they do have options for both non-forgivable loans and forgivable loans. So the non-forgivable one would be one that you're making a payment on, second mortgage that you're making a payment on. It's a nominal payment, probably, $50, $40 a month. But you would have a second mortgage for 3 years. Same with the other program, the 3.5% forgivable one. You'd still have a second mortgage, but you wouldn't ever make a payment on it, and it can be released after 3 years, or after 36 on-time payments.
Jesse, just a quick question. If somebody were purchasing a home, let's say $200,000, and they had 6% in seller concessions, and they're going FHA, would that be enough to cover the closing costs on Chenoa and allow the person to buy the home with no down payment?
I believe so, but getting 6% in closing costs in this market is probably impossible.
But I just want to make sure that those people that are listening know that it's an option. If you can, if the seller's able to pay the closing cost, then you can have the buyer use this program in Johnson County per se.
Absolutely. Yep, that would work.
I have a question here. So we keep saying that the seller's going to pay this much towards closing costs. They're going to pay 5,000. They're going to pay 10,000. Everybody's like, what? I'm going to pay that? But what you have to realize, and we don't see it a lot now, but I was running comps the other day on the house we're listing Friday, and the house down the street, or the one comp I could find, I'm like, wow, this is a really high price sale price. But there was $5,000 in seller paid closing costs, and they added that on top of the price. So if you're seeing some of these people that are paying 20,000 over list, you never know. You need to look at your concessions. They might be paying $20,000 in all of these fees and points and closing costs. If the loan would allow it, they're just increasing the purchase price. So the seller is paying it, but it's going into the buyer's financing because they're making the price of the house higher. Does that make sense? We've been talking about helping the buyer get in, and the type of loan makes a difference. And we were talking about this the other day, that a lot of sellers, myself included, do not like to sell to a homeowner that has an FHA loan right at the moment. But why is that, Beth?
Well, there are, I guess, some myths that have been historical, but there are things that you can fight through. There are certain aspects of an FHA appraisal inspection that they're a little bit more sticklers on. If you have peeling paint, if you have lead, if you have problems with your roof, if you don't have a handrail that is firm, if you don't have electrical box that is up to code, there are certain things that are going to be caught. But honestly, some of my conventional buyers get it caught too. So what we have done now is we will actually present both to show if we can get a person qualified for conventional as well as FHA, but the FHA financing is more favorable for them. The agent can do whatever they need to do in their negotiations, but to show them that they have the capability to take care of some of those things. We also have ways to either increase the price or make some seller concessions to make some repairs that they don't have to rush and get it done before closing, I should say. We can do it after with a lower escrow. So there's a lot, I think, and Alice probably has this too, a lot more flexibility in how an FHA loan works than it used to be. And so a lot of my sellers agents, I'll have a conversation with them. When my buyer puts in an offer with their agent, I will actually call and discuss it with them to, make sure they're not scared to death because it's FHA versus conventional. It's all about communication and the intent of using that loan versus conventional. Because I do whatever I can to make sure somebody is approved by both if I can.
I think it's important to note that not even appraisers are up to date potentially with the fact that the guidelines have changed to the point where FHA and conventional are very similar. And it's really health and safety issues. So when they're talking about peeling paint, they're talking about peeling paint on a home that was built prior to 1979 that could potentially have lead in the paint, and that's a hazard. And that's a hazard for conventional or Fannie or FHA. Now, if you're an old school appraiser and you see some peeling paint, you don't have to call it out if it was built in 2000. You don't. It's not a health issue anymore. It's not a safety issue anymore. So not all appraisers are calling that out. But like the missing handrail, same thing. That could be called out on a conventional appraisal too. So it's important to know as a realtor, and not all of them know, but they should know that the appraisers should be really similar right now. And so to Beth's point, just because we order it FHA and it's got conditions, doesn't mean we'll order it conventional and not get those same conditions.
And speaking as a seller, my main concern really for us is not so much the repairs that we have to make, but we're always looking at, when did we buy this house? How long has it been since we bought this house? And when is the 90 days up?
So that's an FHA flip rule. So if you bought a home and you've been on title for less than 90 days, technically you can't sell the home with FHA financing. So typically what we'll do is we'll have you go ahead and write the contract. We'll order the appraisal. We'll get the file all the way through underwriting and fully approved, subject to that contract being rewritten on the 90th day or the 91st day. There's an additional rule with FHA, and this is just FHA, between 90 days and 6 months, 180 days. If you bought it and you're selling it for more than double what you bought it for, so if you bought it for, let's say, $100,000 and you're selling it for $250,000, it requires a second appraisal. If it's less than 100%, it's usually underwriter discretion. So if you're selling it, if you bought it for 100 and you're selling it for 150, our underwriters wouldn't require a second appraisal. That doesn't mean some lenders wouldn't.
Who pays for the second appraisal, and what does an appraisal for FHA cost these days?
So the lender has to pay for the second appraisal. We
So-
can't charge it.
I'm going to say for everybody on this call that is an investor selling houses or a realtor listing houses, we prefer, I've many times we have called the buyer's agent and said, hey, we've only owned this for this long. Here's the 90-day rule. We're okay with FHA, but we got to do XYZ. And the buyer's agent just comes back having no clue what I'm talking about. So that when that's the case, I go directly to the lender and talk to the lender, because a lot of the buyer's agents are brand new, working with their friends, and they have no idea what they're doing. Not a lot, but quite a few that I have ran into. They don't know because they've only been a realtor for 6 months to a year. They've never sold an FHA house. That is a question. Can I, as the seller, the listing agent, call you guys? You're the lender for the buyer. Can we call you and talk to you? How much can you tell us?
You can always call us. Yeah, absolutely. We'll talk to you. Now, we can't go into the client's personal details, right? You can call us for
Well,
sure.
one thing I was going to say, I'm sure any of us here would love to talk to a seller before they even list, because a lot of them are not educated on a lot of these things that will be asked of them in this market, like the buy downs, the seller concessions. Their agents, like you said, they're newbies, maybe look like it was a great time to make a lot of money and now is not the right time to become a realtor. But if they're educated on the potential, chunk of money that really is not going to be made by them, but is going to be asked by the buyer, I think they need to know that ahead of time so that the listing agent is pricing it correctly. I have listing agents calling me all the time saying, what would be the worst thing that could happen in this? Like, what else do I need to account for in my price? And I'm sure Kevin and Alice would do the same thing, because you're maybe going to get to market that property or help them on the other end with some of their buyers.
So I was doing a little research. I was actually looking for this Chenoa, and I came across a PowerPoint randomly from KCRER. I'm going to share that out to everybody because you can go through and read it. But there are city-specific programs. So there are several cities, at least on this PowerPoint, Summit, Blue Springs, that they want more people to move to their city. So they are offering funding to help you do so. So I'm going to share that PowerPoint on the city-specific.
Grants and things like that too, grants. Somebody asked about nurses. I mean, there's first responder programs, incentives where you can get, $500 off closing costs and things like that, just depending on the circumstances. But there's also a good neighbor program through HUD. Good neighbor program,
Police officers, firemen, and teachers.
yeah, where you can buy, and that could be coming up when we have more foreclosures, but HUD foreclosures, those qualified individuals can buy those properties for 50% of the list price. So that's an opportunity. There's not a lot of those right now, but that's a real thing.
We have a community champions program that's actually a donation program through our company for first responders, active military, teachers, anyone that's employed full-time school district. We as employees actually donate to that program. So they get up to $9.95 off of their closing costs, any kind of loan.
Cool. Well, we are getting close to an hour, so I'm going to go one final round here. So Beth, I know you do a lot of stuff for investors. I know both of you do, but what are some specific things that you offer for your real estate investors to help them either get the loan or sell their house? What are some of the things you do?
I had a newbie in my office today, just trying to make a plan of action. He's 20 years old and wants to become an investor. So I love educating, whether it's first-time homebuyers or investors, to make a plan. But as I said from the beginning, I can come in wherever you are in your investment journey, do a portfolio analysis if you already have them, decide, do you want to go commercial? Do you want to get wrap loans? Do you want to fill up your coffers with everything Fannie and Freddie can lend to you? We go over all of that with your portfolio and decide, do you want to sell to some of your tenants before you have to rehab again? I mean, there are 1,000 conversations you can have in the investment world. And I don't know everything, don't pretend to know everything, but I at least know people who do. I would love to have a conversation with anybody I haven't met yet in MAREI, which isn't a lot of people, and discuss what you're missing. That's a better question, is let me help you figure out what you're missing.
All right. So Alice and Kevin, what do you got going on over in your office?
I'll go first and hand it off to you. So we really have a passion for, and everybody on the team, really, Alice, Jesse on the call, but everybody on the team, we have a passion for showing how you can build wealth through, buying your first property, second property, third property, and then as Beth said, showing them the plan to really building equity through appreciation and principal reduction. Not necessarily cash flow. I think that we all think that's important. We wouldn't advise somebody to buy a property that doesn't cash flow. But in some cases they're doing it, especially on the East and West Coast right now, because they're banking on the appreciation and the principal reduction. Then we show them how to use that and leverage the equity to buy their second property and their third property, and really give them a game plan. We have a deck, a slideshow presentation that shows somebody how they can spend $40,000 on their first house, spend $40,000 3 years later on their second house, but turn those two houses into $1.3 million with no tricks, nothing fancy, just standard appreciation at 4%, standard principal reduction, zero cash flow, and really give somebody the roadmap to becoming a millionaire, multimillionaire, building wealth, generational wealth, passive income, those buzzwords that people like to use, but really it's how to become a successful investor. So that's kind of our passion, and it's my passion, and I love helping people with that. So I'll turn it over to Alice.
Like both of you said, whether you're buying your first home, you're trying to figure out how your kids are going to own a home when they grow up, or you're not happy with where your retirement's going to be, or you're sitting on a bunch of equity. I think it's getting some people out of their comfort zone and understanding how to explain it in simple math, and understanding the key math, and not going crazy on things, but being able to show the power. And I think that one of the things that we really like to do in working with a lot of realtors is help them to learn how to start those conversations with their clients, so that they can not only grow their businesses, but also they can have clients that 20 years later come back to them and say, thank you so much. You've changed my life. I wouldn't have started buying rental properties if you hadn't explained this to me. And partnering with them to really help them feel confident in the fact that this is one of the best ways you could ever use your money.
I know, Beth, you are over in Lee Summit, but if we have questions for you, how do we reach you?
You can reach me on my cell phone number is the easiest, 816-679-4000, or applywithbeth.com has all of my email. Do you want us to put it in the chat, Kim?
That would be awesome. And the same for you, Alice and Kevin. You're in Overland Park, correct? Opposite end.
Our office is in Lenexa. My cell phone number is 913-488-1769. I'm on Facebook and rollermortgage.com, so that you can find us there as well.
And you can also go to MAREI.org and click on business directory. They're both in there. They're both in the latest newsletter. And they're usually at most of the MAREI meetings.
Yeah. And thank you, Kim, for doing this.
Okay, so that's it. I want to thank everybody. I am going to end the meeting for now and see you all the second Tuesday of April.
See you soon.